What's up guys, this is the Crypto Chartist. Welcome to a brand new video. And today I'm going to talk about lesson 1 of my free crypto course. So let's just jump right in. We're just starting from the basics, and I think to understand a bit about technical analysis you must understand the true meaning of it. So to quote, technical analysis is the study of market action primarily through the use of charts for the purpose of forecasting future price trends. So try to understand a bit what that means. I think it's not that hard. So just jump on to the next page. Okay, so these are 3 premises on which the technical approach is based, and in my opinion they are key for a full understanding of technical analysis. So these are the 3 things: market action discounts everything, prices move in trends, and history repeats itself. I'm just going to quote a little bit from a book I've read. It's called The Bible of the Technical Analysis of the Financial Markets, written by John J. Murphy. And to quote a bit about every premises, beginning with market action discounts everything. The statement market action discounts everything forms what is probably the cornerstone of technical analysis. Unless the full significance of the first premises is fully understood and accepted, nothing else that follows makes much sense. The technician believes that anything that can possibly affect the price, fundamentally, politically, or psychologically, or otherwise, is actually reflected in the price of that market. Alright. Prices move in trends. The concept of a trend is absolutely essential to the technical approach. Here again, unless one accepts the premise that markets do in fact trend, there's no point in reading any further. The whole purpose of charting the price action of a market is to identify trends in early stages. So that's what it really is about for us technicians or chartists, however you want to call us. We want to discover those price trends in those early stages, so we can jump in on the right way where the trend goes, and we can make a little bit of money on that. For the history, check. Alright, history repeats itself. Much of the body of a technical analysis and the study of market action has to do with the study of human psychology. Chart patterns, for example, which have been identified and categorized over the past 100 years, reflect certain pictures that appear on price charts. These pictures reveal the bullish or bearish psychology of the market. Alright, yeah, so it's just basically due to the fact that humans have emotions and they never change over time. History will keep repeating itself on and on and on again. We see it in a lot of things, not only in financial charts. So to talk about a bit about the history, the history of technical analysis started into Japan in the 1600s. It was used to predict the rice markets most of the time. It was also used a bit for war strategies and stuff. But mostly to predict the rice markets. And there was actually one god of the markets, just a guy who actually invented technical analysis, and he dominated the market for years. He made a lot of money from it, and actually he was the only one who knew about it until he read a book. And after he read that book, he wrote that book. I'm sorry. A lot of people started using it in Japan, and so it was used in Japan for hundreds of years. It only came to the US and Europe since a few decades. So actually not that long, if you think about it, that it already exists for over 400 years. So yeah, I think it's pretty safe to say that technical analysis is quite an upcoming trend. Yeah, and as I said in the previous page, it still works on this day due to the human emotions, because they don't change. Alright, now let's jump into a little bit of real technical analysis, since you had like the psychology behind it and a little bit of history. To start with the basic concept of trends, like this is really important if you want to understand the technical analysis. So there are three possibilities. There's an uptrend, a downtrend, and we can trade sideways. All the three possibilities are explained in the picture here. So at first I would advise you to take a quick look at this, like the higher low, higher high, lower low. These are important terms. I will use them a lot on my channel. A lot of other channels use them. Just some nice words to learn. So an uptrend, it consists from a high, a higher low, and higher highs. So it always makes higher lows and higher highs, higher lows, higher highs, and it keeps on doing that until the trend reverses. The trend reverses when it makes a lower low and a lower high. So when it tries to come up, makes a lower high, and it breaks down to a lower low, the trend is reversed. And now we are in a downtrend, and the trend will keep on continuing until it reverses. And the thing is, like, trends can reverse like all the time, depending on what time frame you look at. The shorter the time frame, the more it switches on the day. But even though trends switch all the time, a trend in motion is more likely to keep on going than to reverse. That's an important thing to understand. And then we have the sideways trading, also referred as trendless. It's just when the chart is not making higher highs, but it's also not making lower lows. Now we're going to talk a little bit about indicators. So indicators are the tools of the chartist. Just like a construction worker needs his hammer, a chartist needs his indicators. You can't build everything with a hammer. Sometimes you will need a screwdriver or a saw, or maybe even all of them. And that's the same thing for a chartist. To compare like a hammer with an RSI. I mean, an RSI is nice. You can do a lot of things with it, but not everything. Sometimes you will need an RSI and an exponential moving average to make a trade. Sometimes an RSI is not a good measurement in some scenarios, stuff like that. You have to know which indicator you have to use for what situation. And although indicators are called tools, they are actually complex calculations on of the same price information that we use. And in the next page, I'm going to jump into two of the most popular indicators we know these days. I don't know if you heard about it, but we have the relative strength index, the RSI, and the exponential moving averages. So let's talk about the RSI. Let's start with the RSI. It's actually an extra graph on the chart with a scale from 0 to 100 and a line in the middle. If the line reaches above 70, that would indicate an overbought territory, and below 30 an oversold territory. So when you're looking at a trade, and for example a stock or a cryptocurrency is going wild, it's going up and up and up, and you check the RSI and you see, wow, the RSI is in the 85. You can be pretty sure that it won't go up much longer. It won't say it will crash down into the ground, but it just says like, if we go much further up right now, we're gonna hit the 100, and that just means people are buying way too much for the moment. We have here the exponential moving average. There are tons of EMAs out there, all indicated with a number. And the number stands for the amount of months, weeks, or days, hours, 4 hours, doesn't matter, depending on the time frame you look at. So let's say we have the 21 EMA. That just means, like, if we are looking on the daily time frame, the line we see, the EMA line we see, is 21 days of trading action, and then there's some calculation going over that because it goes exponential. So the first day of trading action has less weight than the last day of trading action. So I'm not going really deep into how it calculates the line, but what it simply does is it shows a line on the chart which acts as support and resistance depending on the time frame you look at and depending on the price levels we are at. So to talk a little bit more about support and resistance. Support and resistance are price levels on the charts where we are certain a market does not break through easily. So it's actually just a price level where if the price reaches that level, it's more likely to return to the other side than break through it. But if it breaks through, support and resistance tend to turn around. I'm not really going into why that happens. You just have to take it from me. That's true. The less support a market built on its way up, the harder it will fall when the trend does reverse. The less resistance a market will build on its way down, the harder it will rise when the trend does reverse. So support and resistance can be good and bad things, but overall we just need them. We just need them to make trades. Last but not least, where to utilize your new learned skills, tradingview.com is a perfect place to read some charts. I use it as my number one website for charts. So, and I think a lot of other YouTubers are doing that as well. Lesson 2 will come online soon. In lesson 2 we will go a little bit more deeper into the subject, a more advanced course. We won't discuss any of the things we have already discussed here. Trading is fun, a great skill to learn, but be careful. Investing based on technical analysis can be worthwhile, but it's not guaranteed, of course, just like everything in life. I think that's it. I hope you enjoyed it, guys. Like and subscribe. Don't forget to hit the little bell icon, and may the bulls be with you.